Thank you for joining us. Our presentation today features Giuseppe Ricotta, Portfolio Manager on Lazard's multi-asset team. Please note the information and opinions discussed today do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll turn it over to you, Giuseppe.
Thank you for joining us today for a discussion on the art and science of forecasting. My name is Giuseppe Ricotta and I am a portfolio manager on Lazard's multi-asset team. In this presentation, we will discuss the flaws and biases of professional forecasters, evaluate deterministic and probabilistic forecasting, and finally propose a probabilistic framework to forecasting the market. In all its different forms, investing is forecasting, as it attempts to set a value on future outcomes. Yet forecasting is inexact by definition, and nowhere more so than in financial markets, where predictions are continuously revised from the same moment they are first issued. For example, GDP estimates for the various regions across the world are significantly revised over the course of the year. The same happens with earnings estimates, in this case for the United States. These estimates tend to significantly evolve, sometimes in a dramatic fashion, over the course of any given year. But maybe one of the most interesting examples of how forecasts can be inaccurate is provided by the estimates for the 10-year U.S. Treasury yield from the Phillips Fed survey of professional forecasters. As we can see in the chart in this page, these estimates always drift higher from the current level each month, and usually have very little predictive power on the future level of interest rates in the US. The examples we have seen in the previous pages point to an interesting observation. Prediction inaccuracies seem to be predictable. Not only are forecasts continuously revised, but some well-known biases appear to exist. For example, if we look at the past decade, economists' inflation expectations have almost always been higher than the actual rate of inflation, as we can see in this chart. There is a persistent bias in these predictions. A well-known and even more telling bias is the start-of-the-year bias in EPS estimates. Stock analysts' earnings per share estimates tend to start the year way too high and decrease with the passage of time. Forecast revisions can also be inconsistent with each other. For example, here we see the revisions of consensus GDP growth in the Eurozone on the left, compared to the revisions of consensus unemployment in the region on the right. Over a 6-year period ending in 2019, there have been 18 revisions of these estimates, but the GDP growth has been revised lower 8 times, while the unemployment has been revised higher only 1 time. In fact, unemployment has been revised lower for 16 of the 18 times the forecast has been revised. The evidence we have seen thus far points to our first main conclusion. The future viewed from the present does not end in a single point, as too many factors, both known and unknown, can have an impact on it. In other words, we live in an uncertain world, and attempts to make a very precise forecast seems futile. If we accept this conclusion, deterministic forecasts, such as those we have seen in the previous pages, are really not that useful. On the other hand, probabilistic forecasts, which we will discuss shortly, may provide better results. In a monumental study on forecasting conducted over a period of 18 years, Canadian-American psychologist Philip Tetlock drew a few main conclusions. First, expertise in any given field is not an indication of the accuracy of a forecast, and in fact the specialists with the biggest reputation to defend often make the worst forecasts. Deep familiarity with one single area does not provide an advantage. A better approach is to keep a broad view over a range of possible areas. Second, calendar-driven updating of a forecast is not efficient. It is better to have the agility to respond to new events. Third, teams of forecasters make more accurate predictions than individuals. Fourth, forecasts are work in progress, which need to be responsive to new data. In the words of John Maynard Keynes, "When my information changes, I alter my conclusions. What do you do, sir?" Finally, Tetlock also found that the use of probabilities improves forecasting performance. Over the last decade, within the multi-asset team at Lazard, we have developed a forecasting framework for the global economy and financial market that is aligned with Tetlock's ideas. An investment forecast should account for as many of the subject areas we believe will shape the outcome as possible, while at the same time being manageable. We focus on 4 areas in our forecast: the macroeconomy, factors impacting asset valuations, market liquidity, and investor sentiment. For the macroeconomy, we focus on the world's 4 major economies: the United States, Europe, China, and Japan. Factors impacting asset valuations track the cost of the prime inputs in the global economy, which are commodities, labor, and capital. Liquidity monitors the supply and demand for credit around the world. Finally, sentiment assesses investors' appetite for risk, the impact of evolving policy and regulation, and the geopolitical environment. For each area, we assess the probabilities of a set of 4 potential outcomes, ranging from a very negative one to an overly positive one, in the sense that it is not sustainable over time. Evaluating an infinite number of potential outcomes in a forecast is neither practical nor useful. For simplicity of analysis, it is more convenient to assess a stylized set of potential future states. Financial analysts typically like to assess 3 outcomes: a base case, a bear case, and a bull case. This makes the analysis relatively simple, and it allows to take into account the 2 less likely outcomes, the so-called tails. However, this approach also tends to concentrate the highest probability on the base case, which may not always produce the best forecast. Breaking down the base case in 2, one above the most likely outcome and one below, like we do in our forecast, more fully reflects the uncertainty inherent in any forecast. Our views on the macro areas are expressed in terms of probabilities applied to each potential outcome over the next 6 to 12 months. We use hundreds of macro and market indicators to derive the probabilities in our global forecast and refine them in a qualitative way by drawing on professional investors across Lazard for their views on the macro environment and the markets they cover. Here we see an example of our forecast in practice. As we can see, the probabilities are round numbers in the increment of 5%, as our objective is mainly to capture the directionality of the change in forecast, rather than being extremely precise in forecasting every potential outcome. The directionality is indicated by the green and red arrows. We monitor the probabilities in our forecast on a daily basis and revise them as conditions warrant to keep up with market-moving events. In our case, this approach has led to between 4 and 6 changes per year on average, although in some years have been much more. To summarize what we have learned about forecasting over the course of a decade of research and practice, we believe that a forecasting process should not end at a deterministic point. Rather, we believe forecasters should define and analyze a range of potential outcomes, going from weak and recessionary through below trend to stable and ending at unsustainably strong. Forecasters can do well by assigning probabilities to each outcome along the factors they think are most influential for investment performance. Again, we believe that economy, valuation, liquidity, and investor sentiment have the greatest influence on investment performance and risk. We found that forecasting a specific number for a market variable has little practical value. Rather, forecasting is most useful for establishing a framework that can help to dynamically change the allocation of an investment portfolio over time.